All right. Hello. Welcome. Today we have Scott Stout here with Guild Mortgage, and we just are wanting to have a little bit of a conversation around the real estate market and what's happening in the lending industry and the market here in Southern Utah, and I think around the country is really shifting. And we just kind of want to have a little bit of a conversation about it and see how we can help our prospective clients and customers navigate these interesting times. So welcome. Thanks so much.
Thank you.
What are you seeing right now as, things are changing in the industry? I know I'm seeing houses stay on the market a little bit longer. It's definitely not quite as much of a seller's market where things are flying off the shelf, and we're finding that there's a little bit more negotiating power and things like that. But the people that I've been speaking with are really concerned about interest rates. And so I just kind of wanted to talk to you a little bit about that, get your feedback, what you're kind of seeing, like what the rates are at right now, and if you see any, trends or what you feel like is going to be happening going forward.
Yeah, no, that's a great point of topic for sure. So interest rates going up have had massive impacts on monthly payment. There's a big portion of the population that just flat out can't qualify, even if they wanted to. And then there's a big portion of the population that is just on the sidelines waiting, wanting to time the market, seeing prices getting reduced a little bit, thinking they want to time it when it hits the bottom, which is probably next to impossible because
it's an interesting game of like predicting the future, right?
Yeah. My recommendation to any family wanting to explore the market right now is if you have a want or a need, do it. See where you're at right now, see what a mortgage payment's going to look like on a house that you want. And if you can make it work, great, because you can't time the market wrong. As long as it's a long-term investment, I don't know what values are going to do in the next 6 months, but I can confidently say that in the next, 2 or 3 years, that your house is always going to be worth more than you paid for it. Just always how it goes. Real estate constantly goes up and appreciates over time. And then interest rates too. If you lock in an interest rate right now and they keep going up, you're going to be stoked you did it. If they go down, you can always take advantage of a refinance. It's really a no-brainer. If you have a want or a need and can make it happen right now and budget for a payment, there's never been a better time. You have a lot of negotiating power, like Sarah was saying, and you can negotiate seller paid closing costs. We can use that to creatively optimize your mortgage situation with, temporary and permanent rate buy downs. There's a lot of awesome opportunity that we can explore right now with families. And it's just, doing it with those families that are willing to make it happen, do what it takes.
So let's unpack that a little bit. You kind of gave two situations there of ways to kind of combat that and maybe like ease your concerns about getting into a mortgage right now. And one would be to just know that you have a plan going forward to refinance, but there's some fees involved with that, right? So how big of an interest rate, change or fluctuation would it be that would warrant going forward and actually doing a refinance, and like what is involved in that?
It's going to greatly depend on the loan amount. Larger loans, 0.5% could really make sense with a refinance. 0.5% lower in interest. Typically, rule of thumb we've always used in the past when the average loan amount was like 200,000 was about 1%. When the interest rates dropped 1%, it would make sense to refinance. But everyone's situation is going to be a little bit different. It probably, I would say, between 1% and 0.5% would be a good indicator. But the costs of refinancing are going to be fairly similar to, closing costs on a purchase. You're going to have to pay title fees, title insurance again, and then, prepaids for tax and insurance.
So it really comes down to kind of like knowing what your long-term strategy is, right? So if you plan on, you have a $700,000 house and, you pay a high interest rate and then all of a sudden interest rates drop and you're planning on staying in it for another 15 years, then probably paying those upfront costs to get refinanced would make sense. But going into the mortgage, if you know that this is a temporary home, if maybe you're just starting a family and you're going to be, upsizing, or if maybe you're going to be transferring for work, the interest rate doesn't make that big of a difference right this minute. And so having the tax write-offs and all the things involved with having your own home and having your own space and being able to remodel or do any things that you want, really does make sense for a lot of people if it's not going to be this long-term thing, correct?
Yeah. Typically, if a refinance is ever going to make sense, you want to have plans to be in the home for at least, 3 years.
Okay.
Depending on how significant that interest rate drop. If you're dropping it a couple percent, which could potentially be likely, in the near future, in the next couple of years. And, even if you're in the home 2 years after that, you'll still save money in the long run by a refinance. It's just going to be totally unique to everyone's situation. How drastic the payment change is, what your long-term goals are with the home, and what you're wanting to accomplish.
Are you seeing anyone using an adjustable rate mortgage right now?
They're starting to make a comeback. There's still not a massive appetite for banks to do a adjustable rate mortgage, but they can be a great option. And typically how they work, there's a lot of misconception on adjustable rate mortgages, and adjustable rate mortgages nowadays, they're fixed for a certain period of time. And depending on the adjustable rate you choose, it could be fixed for 5 years. It could be fixed for 10 years, 7 years. There's a bunch of different options, but as long as if you go into buying a house and know for a fact that you are going to be moving when you start your career in California or whatever your plans are, whatever it may be, and it's a 5-year home for you, then a 7-year adjustable rate mortgage might be a good bet, because that gives you a 2-year buffer and it's going to be fixed for that amount of time. And it'll only adjust after that first initial period.
That makes sense. Okay, so another thing that I wanted to talk about, we obviously are concerned about buyers and where they're at and how the affordability changes with interest rates, but obviously sellers are concerned too. So, they're seeing houses stay on the market a little bit longer, and they're seeing that their price reductions are happening. And a lot of the sellers that I'm working with, I want to make sure that I'm giving them good advice and the best way to put the best foot forward. And so let's talk a little bit about the difference between if a seller was, had their house listed at $750 and they were ready to maybe make a $50,000 price reduction. Sometimes that's not the best option for the buyer. Is that correct? There are other ways as far as doing point buy downs and things like that. So let's kind of explore that on the numbers of how that would be if a seller was going to offer something rather than just doing a flat price reduction. What could they do to make it more appealing to the buyers? And then how can we as real estate agents and people in the industry educate the public about what that means? Because the average person obviously just looks at the price and they don't care about anything else. But I want to get some information out there so people understand that your seller can really do you a favor by offering you a $10,000 rate buy down versus a $30,000 or $20,000 price reduction.
Yeah. So it depends on your situation, right? If you're focused on monthly payment, which 95% of families that are buying a house right now, that's their main focus, is what the monthly payment is, then you're going to have a lot more bang for your buck on monthly payment. Instead of asking for $25,000 in a price reduction, even just asking for $15,000 in a seller credit to permanently buy down the interest rate. $15,000 to the interest rate will lower your payment potentially, $100 or $200 more a month versus $25,000 in a price reduction, just depending on exactly what that loan amount is. But you get a lot more bang for your buck asking for closing costs help, which is very common now. I don't know, Sarah, these probably 40% or maybe even 50% of homes that are financed are getting some sort of seller concession right now.
Right.
Help optimize their mortgage
Which
situation.
wasn't the case a while back. So again, you need to understand that too, that yes, the prices are the interest rates are changing, but again, you have more buying leverage now in this market, right?
Yeah,
exactly. For sure.
So
Well, I love that there's at least some good options out there. And I think it just goes to making sure that you're working with a qualified lender that knows the different things that are available out there. Same thing on the rate buy down. If you're only going to be in that house for a year and you can afford the monthly payments, then that probably wouldn't be a smart decision because you'd be better off to take the price reduction. So you really want to make sure that you have the professionals in the situation that kind of understand what your long-term goals are and what it is that you're trying to do so that they can give you the best advice and show you the best options out there.
Yeah, exactly. If you're contemplating, buying a house in the future, at least sit down with the lender and see what it would look like now. It might not be the right time for you to buy, but at least you'll understand what it would take right now and what it's going to need to look like for you to jump in and make it happen.
I talk to a lot of people. I own rental properties. And, just inevitably when people are calling on homes and things like that, I get a lot of people that are current renters and have never owned a home before. And I actually had a conversation yesterday with someone and they were asking about a rent to own program that I was telling them about that unfortunately is actually not available in our area right now, but in some of the larger metropolitan areas, it is. And it can be a great option for people that maybe don't have excellent credit and are not quite in a spot that they can qualify for a loan. But I asked the girl and I said, well, like, have you considered buying? Like, have you actually sat down with a lender? And she was like, oh no, I just assumed that I wouldn't be able to. And so I started to kind of ask her a couple of questions and I was like, do you have solid income? And she said, yes. And I was like, have you been at your job for more than 2 years? And she said, yes. And so I think it's interesting. I think a lot of people just automatically assume that they can't get qualified. So let's just talk a little bit about that process of, what things are they going to have to bring into you? I know it depends on the individual and their circumstances, but just a general ballpark. What are kind of like the basic qualifications that they would want to have at least some of those boxes checked off when they're ready to come in and at least see if and when that's a possibility?
Yeah, so really we start out with getting a questionnaire complete. We can do that over the phone or in office, or if you want to, even online. From that, we'll know what, if any, documents we need to round up. There are times where we don't have to round up documents. Everything's verified electronically, which makes it nice. But certain employers can't be
I
verified.
have never experienced that as a self-employed entrepreneur.
Yes, if
I
you're
didn't even know
self-employed, we
that.
got to get your last 2 years taxes. We got to get your W-2s and bank statements, and if you pay yourself, pay stubs. And each person's going to be a little bit different depending on your employment situation. But typically, if you're a W-2 employee, just your 2 most recent years W-2s, tax returns, and pay stubs.
What type of a credit score are you seeing people get qualified for approximately?
Depends. If credit's usually in question, typically it's going to be the first-time home buyer looking to buy their house with 0 down. Ideally, 660 would be a good goal because that opens up the door to any first-time home buyer program.
Okay.
And technically, you could get a loan if you have a down payment as low as 540 credit. Not very often. You have to have a pretty substantial down payment of at least 10%, but FHA will allow, sub 540 credit.
Okay. But I'm assuming that when someone comes in and maybe their credit isn't great, that like you'll kind of sit down with them and explain like, hey, this on your credit, or, this derogatory remark, or, these different things, like maybe your revolving balance is too high. Like you would be able to kind of sit down with them and let them know like what they could be doing and what steps they could take in order to get to the point where they would be able to get approved.
Oh yeah. Lender is your best free credit repair company you could work with. So
it really is, because again, like there's no charge for that, right?
You.
Like
help educate you, know what to do, what to pay off, what accounts are going to have the most impact on increasing your credit score, and give you a roadmap to follow to get there.
Okay. Awesome. Well, do you have any other advice for people as they're navigating this market?
If I was, looking to buy a house right now, I'd jump in, see what it looks like exactly, make sure it fits within my budget, me and my family's budget. And if it does, I'd jump on it and make it happen, because in the end, it'll always pay off. The best time to buy a house was always last year. And in the long run, there's no greater investment than real estate. So see what you can do to make it happen if you can. If you don't know if it's possible, sit down with the lender, explore some options, and at least know what it takes, to get a mortgage and purchase a house and start building your wealth.
Let's do it. Start building your wealth. I was just talking to a financial planner. So getting those
Yeah.
things, getting your taxes in order, all of that stuff is important too. Like keeping your books up to date and making sure that you are, have a tax advisor that is making the best of your tax situation and just your financial plan in general. So I appreciate your time. How can people get a hold of you?
So you can reach me here. Work with Guild Mortgage. My cell phone is 435-229-5747. Reach out, call or text. Be happy to be a resource for you, whether the time's right for you now or down the road. We'll always be here to help.
All right, perfect. I really appreciate your time today. Thank you so much.
Okay, thanks, Sarah. You're a rock
Have a
star.
good
Appreciate
one.
it.